Welcome, crypto enthusiasts, to the Independent Reserve Podcast.
Episode number 5 of the Independent Reserve Podcast. We've got Glyn Jones today. Glyn, how are you?
Well, nice to be here. Thank you, Lee.
Great. And we've also got John Toro, Head of Trading as always.
Great to be here. Thanks, Lee. I didn't actually know JT's full name until just now. Well, I've been called John. I've been called John and Jonathan. I'll take John.
According to the Ep5, it's also John Toto.
Lovely.
His name got misspelt in a recent Ep5 article. But you did get an apology for it, JT.
It was a really great article. So very happy to be misspelt and have an alias now.
Good. John Toto. Glyn, do you have any aliases?
No, none that I think I could repeat in a format like this.
Good. But we're going to jump through, because I have trawled your LinkedIn to get a bit of background before we get into what you're doing in crypto now. But as far as blue chip TradFi experiences go, you've had them all. So you're a general manager at ANZ, a managing director over at Standard Chartered. You're an MD of global markets at Deutsche Bank, executive director at UBS on fixed income, and also a VP at Credit Suisse. That's pretty, it's around the traps.
Yeah, some would say the fact that I moved around a little bit suggests that perhaps I was getting moved on. But so I was very lucky. I had 20 years working across institutional banks, mostly out of the Northern Hemisphere, before I came back to Australia. And I really enjoyed it. Very grateful.
Very good. And now I guess you're doing some work more, definitely in the crypto space. You're a founder at Ledger Capital. Also working with Cormin, doing some work there now.
Yeah. And
founder at Icebreaker Finance as well. So you've moved in heavily, well, not heavily, but moved decisively into blockchain technology and crypto. How'd you find yourself there?
I think a couple of reasons. One is the steady paycheck that large banks offer. I was in the fortunate positions they got older where I perhaps didn't have to attach as much need to that steady paycheck as perhaps I might have when I was 10 years younger. The industry was very kind to me for a long time. So that opened up a set of, removed some constraints, as it were, about what I wanted to do. I think second of all, perhaps while in institutional banking was wonderful, I'm really grateful for the time I had, the people I met, the experience I got to work all around the world. I perhaps wasn't having that much fun anymore.
Mm-hmm.
And as the older I get, the more I frankly want to have fun. Fun's a bit different now. It's probably less alcohol involved, but I want to have more fun with my work and feel passionate about what I'm doing. And I wasn't feeling the passion as much. And probably the last point is, I think at the peaking end of financial services, particularly in Australia, I'm not sure I had the skills to progress further.
Mm-hmm.
There's a certain skills around navigating complex, large organisations and cultures and bureaucracies that I think requires a deftness of touch and a sensitivity that just is not my strong part. So I found myself in a position where, for all those reasons, I wanted to do something a little bit different. I wanted to do something more entrepreneurial. And I've always been playing in and around the edges of crypto as an enthusiast. And I thought, well, if I don't do it now, I think it was 45 at the time, if I don't do it now and have a punt in something more entrepreneurial, I was probably never going to do it.
Mm-hmm.
So with that, I went off and giving it a crack.
And here we are. And I guess your core focus is really around Bitcoin mining, but also lending.
So I've tried to ask myself the question of what are the skills that I've developed, which I think I can port, which is still relevant, recognizing crypto's a very, very broad church. And there's enormous parts of it where I arguably don't have comparative advantage or skills to bring. So I've tried to focus on credit, fundamental analysis, do some of that around credit origination, distribution on chain, which was the business that we set up and then ultimately failed around launching a credit fund on chain for serving the Bitcoin mining sector. And Bitcoin mining, where I'd had some historical relationships, and I was eager to get focused in one particular part of the ecosystem.
So Glyn, when you decided to make the leap from the old world into the new world, what was it about maybe the technology itself or, the opportunity that kind of attracted you the most and said, yes, I'm going to make this jump and have a go at this thing?
So I think the fact that it's a sector which is not well understood, which is changing very, very quickly, both in terms of the underlying technology, the regulatory landscape, what the use cases are, I think that just makes it incredibly interesting. There's an enormous amount to learn. there's an opportunity. The business models are changing, and I think whenever business models are changing and evolving really quickly, that usually brings commercial opportunities. So that just in itself makes it really interesting. I think there's something around blockchain philosophically, and particularly around Bitcoin, where I spend most of my time, that I've always had a little bit of a bias with sort of a vague economics training to look at monetary debasement and some of those sort of economic trends, and find some of the store of value thesis around Bitcoin really interesting. So I think that coexisted really nicely with it's a new industry and lots to learn and do. So I think that really appealed to it as well. So overall, I just found it a very compelling area where I thought, as a sector, it's only going to grow. Now, if you've worked in institutional banking for the last 20 years, growth is something, frankly, you're not accustomed to. What you are accustomed to is shrinking teams. So I've probably laid off north of 300 people over the past 20 years, and been in, like, heaven knows how many restructuring rounds. So to be in a sector which may be volatile, but perhaps over the long term has, I think, significant growth potential, that's really interesting. And when I think about where I want to spend my 50s, I want to spend it around in an industry which is growing, industry which is changing, and the opportunity sets constantly changing, which is intellectually really stimulating, and where some of the skills that I've got around navigating regulations and markets and product innovation can be relevant. And I think all those things are true in crypto.
Growth and opportunity, absolutely.
So I'm glad I'm here.
Yeah, well, good to have you. I guess my next question would be sort of, given that you kind of straddled both worlds, what do you think is still most misunderstood about the digital asset blockchain industry from your perspective?
That's a big question. I always do it from both sides. Also, I'll try and speak out of both sides of my mouth.
Yeah, perfect.
With the TradFi side of my brain, this word crypto, gosh, that's a big word. There's a lot in this thing called crypto. And I always find that term, actually I'm talking about the crypto side of my head rather than TradFi. I find that term quite unhelpful, because everything, we were having a conversation before we started rolling about meme coins, and a conversation about what is the value of meme coins and what is the utility of those meme coins, how to value those things, how do I think about that, to having a conversation about Bitcoin store of value, to having a conversation about what smart contract technology may be able to do with a distributed ledger. They're three totally different conversations. We just put this word crypto and sticker at the top across them. And in the way I think that makes us an easy target as an industry for misinformation and for prejudice, when really we've got to disaggregate that. And I would say in the same way as payday lending in financial services probably has very, very little to do with M&A transactions done by and primary capital markets done by a regulated broker-dealer. Those two things are fundamentally different business models. I think the same is true as in crypto. So I'd almost throw that word in the bin and talk about them in different segments. So from a TradFi point of view, if I think about store of value, where I spend all the time, and proof of work, I think one of the criticisms of that, and particularly in the context of Bitcoin mining, is around value creation and the lack thereof, where there have been many, many Bitcoin miners, participants, where the shareholder value creation has been negative, real destruction of shareholder value, and that's been consistent across almost all the names through the cycles. So I think that would be one criticism of that part of it. And then I think when it comes to the smart contract technology, I think people would, in TradFi world, would look at it and say, oh, I sort of understand some of the concept, but where is that concept translating into a use case which is generating tangible value for participants, as opposed to recreating intermediaries? And I'm sure you guys would agree, and I'll be quiet in a second, but you go to many conferences of crypto, and what you find in a room is a collection of intermediaries that in a different ecosystem smells just like it did in TradFi. It's just in a different universe. But I thought the whole concept was less intermediaries and removing some of those inefficiencies. So I can sympathise with some of those challenges that TradFi come across. But at the same time, with my horrible single word crypto banner on me, I'd say it's really, really early in this technology. And we're still figuring out what some of those use cases are. And I think some of those use cases are starting to bear fruit, and more will happen over time, and many will slip by the wayside. And that creative destruction is just innovation at its best, and the market will take it where it goes.
Yeah, absolutely. I think the terms like crypto are unhelpful because there is so much, and if you're new to the space and you just lump it all in one together, you're mixing up what's going on with Bitcoin mining with meme coins that are pumping and dumping all the time, and they're just very, very different things. So Bitcoin mining is kind of your forte. For those who aren't familiar with the economics and what it all is, did you want to quickly throw through that? I know it's a big question, but let's start with maybe how it works and then the economics of it.
So within the Bitcoin protocol, we have this concept of proof of work, which is where how the network is secured and transactions are validated. And that relies on, without going into SHA-256 or not, it relies on miners participating in that. And in effect, miners spend electricity to perform a function and apply computational power to problems. And by doing that, they secure the network. So when we say, what is a Bitcoin miner? In one form or another, it's a Bitcoin miner that is acquiring power. It is throwing that power at a set of computers, which we'll call ASICs. Those ASICs are doing a job that they are configured to do, that one job, and pretty much that one job only. Small number of manufacturers of that. And Bitcoin miners are compensated for doing that. Now, so that's the act of Bitcoin mining, and it has some really interesting traits about it as an industry, which play to its competitive nature, and that is, one is, all Bitcoin miners, we're all pretty much doing the same thing. We cannot differentiate our product. If I take independent reserve versus other exchanges, you have many different ways to differentiate the product and service that you would offer. In Bitcoin mining, we all produce exactly the same thing. And you can do it from anywhere in the world. So you want to not tied to a location. You have no distribution costs, as it were. You have no ability to differentiate your product. The only thing you can do is differentiate by your cost of production. So whether that cost of production be in terms of cost of capital or cost of capex or opex. So it very quickly becomes a Darwinian cost game. Is who's the leanest and meanest in town. Now, that all being said, it's an industry where there can be times, because there is only so much electrical infrastructure in the world, can be times when the rewards for Bitcoin mining increase dramatically, and there's only so many participants in the pool. And those participants get to feed off a larger reward pool. And sometimes that reward pool, we've seen it in the past, can get very large very quickly as Bitcoin price accelerates quicker than the number of miners that can participate in the network. So it's an industry which is also really volatile. But back to that Darwinian point, I think the most fascinating thing about Bitcoin mining is not in the boom market, it's in the bear market. But that industry gets really, really interesting. Because in the bull market, there's only so much electrical infrastructure, the fee pool is growing, everybody's just trying to get miners on as quickly as they can, and everybody's usually making what seems to be a good return on capital employed. In the bear market, Bitcoin price falls, there's a bunch of people participating on the network, everyone's still trying to mine, the fee pool shrinks, all of a sudden, those Bitcoin miners find that their revenue stream is, in dollar terms, is collapsing. Yet they've still got to pay for power. And that's really, I'll use that wonderful TradFi expression, that's where you find when the tide goes out, who's still standing or not. It's not in the bull market. In the bull market, it's like a call option. Everybody participates and makes wonderful money.
And is there a floor price that has historically been set where the Bitcoin miners have a break-even level?
Yeah, really good question. So if we could think about, hash price, which is that a way of thinking about what is the dollar revenue earned for throwing a given amount of computational power onto the network. So a miner takes energy, applies that energy to computational power, gets rewards. So what is that number? And hash price, which is a term that Luxor and Ethan and the team came up with, which everybody in the industry monitors as expressed in US dollar terms. So that number for the past little while has been frankly quite wonderful, far higher than I would have expected because of Bitcoin's price appreciation. And that number's been in the comfortably north of 100 most of the time for the past 3 months. It's been wonderful. It has got as low as $57. It has got as high as $400. Now, that's thinking over quite a long time span. So just in what I've just said there, as low as 57, and always think that as unit revenue. How much can I sell the sneakers for that I make? How many industries in a 3-year period can go, well, I sell these things at scale for 57, I sell them at scale for 400.
Yeah.
Wow.
Volatility.
Absolutely transformed that business. And to your question, I guess my thesis would be, and I suspect many other commentators would agree, so what I'm suggesting is not particularly revolutionary, that as the industry matures, more professionals who know how to originate power and deploy power in a really cost-effective manner, those that do that, then as they attract into the industry, that resistance level on price falls. So where the low used to be 57, when I think about what the low might be in the next 5 years, in a world where Bitcoin were to depreciate sharply or stop appreciating while lots of miners come onto the network because there's a fixed supply there and everybody's feeding from the same trough, I think about that number being in the mid-40s now, if I was going to take a guess. And we've got to remember that there are some participants on the network who are not rational economic actors. There are some states now who have access to underlying mineral rights and resources, and it's difficult to collect data on this, who are involved in Bitcoin mining in increasing scale. There are some people that perhaps for illicit purposes may wish to effectively transfer expenditure on power to getting an asset that's borderless. So how much of the network that represents is unclear, but certainly that pushes the resistance level lower. So no one's thinking at the moment around, well, where does it go to? Everyone's thinking it's a bonanza and let's all make wonderful margins. Whether investors end up making good returns, I think is a different question. Albeit the halving is now not that many weeks away, and that changes some of these economics.
The halving was going to be my next question. So how do we start thinking about things knowing that the reward pool is about to get cut in half?
Yeah, so I think whenever you're making an investment into any asset, no different than if we were building a toll road and we think about, well, what is the useful life of that toll road where we'll be able to monetize that investment we've made? You would hope that with most mining infrastructure, whether it is the transformers and the substation you deploy, or if you're doing it off-grid on an oil patch, some of the infrastructure around that, around compression, through to ASICs, it'll vary somewhere between 3 and 10 years, depending on type of infrastructure. Some of the transformer substations, maybe 20 years. So I'll try and make decisions about with a slightly longer time frame. So when I think about the halving, one of those sort of over that 3 to 5 year time frame, one of the structural questions you've got to have a view on is transaction fees. So at the moment, if we look at, say, Ethereum today, which is proof of stake rather than proof of work, so a different mechanism for securing it, we know and we all are accustomed to doing transactions and like, oh my gosh, that's just got very expensive. Why do I like Solana so much? Whoops, Solana sometimes falls over. That's why I like Ethereum. But nonetheless, we see that fee spike. And that fee pool in Ethereum as a consequence of transactions participating, competing for a given amount of space is quite material. In Bitcoin world, that transaction fee pool has been arguably modest relative to the market capitalization. So fee pool small. And there's been a couple of little times with BRC20 and a couple of other innovations where we've seen the fee pool increase. So the question we've got to ask ourselves to answer how we feel, not just about the halving, but really how we feel about the next 5, 10 years. If you're going to make investments in infrastructure which require a 5, 10-year payoff, what you're really doing is expressing a view on the forward curve of transaction fees. If you believe that use cases beyond store of value will come to Bitcoin over time, and you believe that even while Bitcoin and its protocol and programming is arguably quite rigid, that humans are fundamentally creative and finding ways to put smart contract style functionality into Bitcoin and Bitcoin layer 2s to the extent that some of the transaction fees accrues to the underlying miners, then you would expect transaction fees to grow. If they grow, maybe they grow so much they become just as, if not more important than the mining reward. Whereas today, in most months, and there were a few months where this wasn't the case, mining reward is the predominant share of the income that a miner receives. So when I think about the halving now, then unambiguously, while you would say the rewards halve, they won't quite halve because transaction fees will be still be there, but they will reduce materially. Over the longer term, some people say to me, well, go through a couple more halvings, there'll be nothing left for you guys. What are you going to be mining? And then to which my answer to that is, do you believe that in 3 halvings, what probability do you attach to there being materially no use cases beyond store of value? If you attach 100% probability to that, they're probably right. I don't. I attach a material non-zero probability to there will be more transaction fees around Bitcoin, which makes me believe when I think about that economics, there's some sort of option and embedded option in that you're participating in. Now, more specifically around the halving, which is coming up. The halving is really powerful because all of a sudden you find as a miner, hey, I was earning this much Bitcoin and I'm now earning not quite half, but let's just for simplicity's sake call it half. And I'm still paying for electricity. Mm-hmm. I've still bought all this infrastructure. So what are the miners hoping for? Well, I think there's a camp of miners that say, that's okay. Bitcoin's 69.5. I've tried not check it for about 12 hours. I'm trying to go longer periods of time without checking the price as a mental health measure. But they would say, that's okay. Bitcoin's probably going to be at 100,000. It's going to be at 120,000 within 6 months. Network activity as a function of people spending capital on electrical infrastructure could only grow so quickly. Therefore, that unit of hash price unit revenue, that won't halve. That might fall from where it is today, but might end up being 60, 55. Conscious of that previous sort of lower around the 57 number. Now, and people will have different views on that, but there's certainly 99% of miners, say 95% of miners, are not looking forward to the halving. Then there's a small subset that probably are looking forward to the halving. And I think this is the subset that I want to spend as much time with as I possibly can and invest in and work for and work with. And that is miners who believe, wrongly or rightly, that they have a differentiated capacity to source power and deploy that power with capital allocation choices into infrastructure at much more attractive rates of return. Because you can't control what comes out of the Bitcoin. And because of this Darwinian notion, if there are a lot of people today who may be deploying their capital into Bitcoin miners in places where they're paying, let's call it 6-7 cents US kilowatt hour for power, then in a world where hash price goes to 50, those people are probably underwater. Gross margin negative. So if your gross margin negative, your rational economic decision is turn that thing off. When you turn that thing off, the network hash rate drops. The residual available miners get to hoover that up. So their economics deteriorate far less quickly than you would otherwise think. It's non-linear for them. The further you are out on the distribution curve, the more pronounced or more positive that convexity is for their performance. So if you believe you can be a miner that is in the top couple of % of network hash rate in terms of efficiency, then actually the halving can open up some really, really interesting opportunities because there will be ASICs that no one else can make money from, that the market might attach a value to of just about zero, buy them for scrap. Whereas that implicit call option might actually have a premium flow that's valuable to a miner who's got power in the best couple of %. And in a bull market, they fully participate. So I think there are slim miners who will look forward to it. But at the minimum, everybody should be preparing for it.
There's so many questions. That was a great summary. There's so many questions there to ask. I've got to think, where do I start from first? What are some of the key metrics that you're zeroed in on then to see who are the ones who are being efficient, the ones that might go, you know what, post-halving, we're going to benefit from the fact that some of the economical ones are going to turn off? What do you look for to see, to find those people?
So obviously, you could participate in Bitcoin miners in public markets or in private markets. The number of public markets listed in the United States in particular and Canada is now north of 20. I think it's 24 the last time I checked. And they all have reporting obligations. Now, some of them are foreign issuers, like listed, take someone like Iris, foreign issuer listed. So therefore, their disclosure obligations will be slightly different, or similarly in Canada. But nonetheless, there's a plethora of public miners participating. I think if anyone was contemplating investments in public miners, one thing to sort of keep in mind is the industry is immature. Therefore, as the industry is immature, therefore there's not a lot of consensus about how to price and how to value this thing. Because price discovery and valuation is still something where everybody's learning the ropes. And that goes all, and I say this with the greatest respect, to investment banking coverage and research teams that are out there putting out their research notes. Well, those people writing those research notes, and there's maybe 12 analysts who cover the industry. I've had the pleasure of meeting most of them. Most of them came across Bitcoin mining less than 3 or 4 years ago. Now, before that, they might have been doing semiconductors or something else which had some heavy capex. So they're all still learning it. So I think it's one thing to keep in mind. Now, I would argue that wherever everybody is still learning information, that means information asymmetry. That means if you're willing to do the homework, even as a retail investor, you actually, if you're willing to do the homework, you have a chance. Whereas I would argue that a retail investor trying to have insights on industries which are more matured and deeply covered, I find it really hard to convince me that you'll be able to generate insights over and above what others will be able to do. So I think that in a way that's a positive for the industry. When I think about the specific metrics, because it's immature, there's not a lot of consensus about what some of the metrics are. And I'll give you an example. When you look at the income statement for most companies, the statutory accounts, say under US GAAP, will say, well, describe what your net income is, please. Almost all companies will say, well, thank you, there's my net income. But what they want to talk about is EBITDA, earnings before interest, tax and depreciation, amortization. And then what they want to do is say, but not all of EBITDA, because that's got some things in there that I don't want you to focus on because they're abnormal. They don't represent my underlying, and every company does this, listed. They'll talk about adjusted EBITDA. So net income, take some stuff out, don't want to talk about that. EBITDA, take some stuff out, don't want to talk about that. Then they want to talk about adjusted EBITDA. And they'll then use a set of metrics around, I've got this much hash rate, this much computing power installed, this much megawatts installed, and I'm generating this EBITDA, adjusted EBITDA. I think that's an interesting metric, but at the same time, what I sort of keep reminding people is that this is a capital-intensive industry. So what I'm really interested in is deploy a certain amount of capital, whether public or private markets. What return do you generate on that? Now, in a public market, we can get that through share price appreciation or dividends. None of the miners have paid dividends. The share price appreciation, most of them are well down on where they listed at. So total shareholder return, which any other normal industry would talk about for, I'd have to go check my numbers here, but I guess for every single public listed miner, is substantially negative. If you invested when part of the IPO, you are down. So that doesn't mean there are some participants haven't made money through. So what I would encourage anyone, whether you're in public or private markets, is to really think holistically about your the metrics you're using to assess the business. Think about capital employed, returns. Then as you apply those lenses and those measures, and you can get into all kinds of hash cost and all kinds of good metrics around that, dollars per coin to spend. Then the next thing you've got to go and ask yourself is, well, this is the Darwinian industry. So the best miners, to them will accrue a disproportionate share of the economic value of the industry. The average will not do well. The worst will do appallingly badly. So I think in some industries, getting the average, you'll sort of get GDP plus on sort of your return. And you'll get your risk-free rate plus you get a premium. I don't think that economic model works in the Darwinian industry like Bitcoin mining. So you want to have conviction around, I'm playing with the top. And I'm picking them. Does that help?
Yeah, it definitely does. I guess I was really interested to see what do you do to find the top and what do you think the top are doing that makes them the top?
So, and the challenge here is I'll say a bunch of things which sound really sensible. I think many miners will say they're doing. And then the challenge in the due diligence process when I was a prospective lender to them is to do the homework to figure out who has read the playbook and is saying the playbook versus read, saying and doing. Now, if they're not even saying they're doing it, that clearly push them off the side. So one is, if you know that in Bitcoin mining, back to that, what is it all about? Procure power, deploy power in a really intelligent way into ASICs, that you've had a really thoughtful capital decision about when you buy them, which type you buy, and how you deploy them, and then how you operate them. really come right across that full stack, and I'll think about what that, go looking for people who have deep expertise in sourcing power. Now, I know little about power markets. I've tried to be a student for the last 3 years, and the last 25 years of working has taught me that when I was 29, I used to think that you can learn everything you need to know in 2 or 3 years in something. The older I get, the sort of more humility I had that actually 20 years of experience in something really, really counts. And smart people who've learned on that, focused on that for 20 years, have accumulated a vast wealth of knowledge. And I see that in the power markets all day long. So power markets, everything from the relationship with the utility, structuring electricity contracts, participating in co-ops, navigating QSEs, participating in trading markets around power. So when I go looking at a miner, I just go and look at saying, so who are the people on that leadership team? And show me the last 15 years in power, 20 years in power markets. Now, if they do not have that, then either they're super quick learners, possible, and they've got a real edge. But procuring power, keep in mind, is not a new thing. That is something that is well established in the industry. So I'm a bit skeptical about that. They're just quick learners. Or they are sort of industry price takers, not really seeking an edge in that part. Well, if source of power, unlike in sort of HPC or AI data center, where power is a minority of your overall cost base, in this game, power is the majority of your cost base. So you need to know that team is just bread and butter power. So the people that I work with, and Clement, where I spend a good chunk of my time and I'm an investor in and an employee in, that is founded by someone who used to be on the floor trading in power markets. The advisory team around that and the directors around that have spent 20 years. One of them used to run the power desk. It happened to be Deutsche for many years. Another one at large utilities in the United States. So got to have power. And if they don't have power market expertise, then I'm wary. Next thing I go looking for is engineering acumen. So, and that engineering is really, really broad, from electrical engineering, how to build and operate substations, how to design them. Because if you need to be able to have the in-house design skills to design, fabricate everything from your substation down for that one job and one job only. And that's the only way you'll get your cost per megawatt deployed, less than everybody else. So engineering acumen, again, I go looking for, so show me the guys that know everything from electrical engineering to mechanical to plumbing. Sounds crazy, but if you don't know a hell of a lot about fluid and fluid dynamics, then you're probably not going to know a lot about cooling. And cooling is really, really important in data center applications. So show me the team that have spent 15 years and have done PhD research papers and know how to do that. Because if they're turning around and they're buying that skill set from someone else, then it's unlikely that they are going to be in the very top of the curve. So we've talked about power, we've talked about engineering. The other thing I talk about is capital. So this is the capital intensive business. So show me people on that team who know how to originate capital that's attractively priced across the full capital stack, and then how to risk manage that capital, including managing their hash rate, their difficulty position, managing their Bitcoin position, participate in derivative markets. You've got to have all of those things. And then I'll do one sort of overlay. They've got to be frugal. You drive up to a Bitcoin miner and you see a flash car park and nice company cars, you just turn around. So I'm all for a little bit of company merch, hat, shirt, happy days. But if you see management teams that haven't put significant personal capital in, but are being granted very large option packages, which I would argue is just a call option on beta, and you shouldn't pay executives call options on beta, to state the sort of obvious economic theory. So you want frugality. And that means you want teams that when they get on the plane, they're turning right, not turning left. You want teams where they're really keeping it tight, because how you compete is by having the lowest cost Bitcoin. So they're my three that I always think about. Power, engineering, capital, put frugality under all of it, and do that one job and do it really, really well.
Very, very, very thorough. So can you be so bold as to maybe give us a couple of names of people who you think are doing pretty well in all those categories?
So obviously I shouldn't talk about the people I have invested in and work for, because that would be inappropriate. If we go to, I've clearly got a massive bias. If we go to the public companies, I think, I won't say names, because I think each of them, I see them at conferences, and the people I don't say may then say, why would you say that, Glyn? Because everybody's just trying to do their best and make this work. One of the things I'd encourage people to do, a bit of metric, is just go and look at the dilution. So many of the public miners have what's called ATM or shelf facilities. So if they're listed, they've got liquidity in the stock. They can effectively go out and raise money at the market. They don't go and do a secondary offering. They just go to their broker and say, sell a few more shares for me, bring some cash in. Now, the amount of capital raised just in the last 3 months, as the market's really accelerated, is staggering.
There's been real dilution, hasn't there?
Many hundreds of millions. So I would say just go and have a good hard look at that. And then go and ask yourself whether that management team has a track record of the last time they did a big dilution, whether they've delivered share price appreciation and dividends, the combination thereof, to those investors who participated at that time. That's question one. Question two is whether that dilution was linked to share grants, where those management teams are exercising into market rallies. Because while I think we can find many investors in the sector who have not done very well, we can find many executives who've done very well. That is, from an investor's point of view, which is something to run a very long way away from. Now, all that being said, I still think there's some really interesting parts of the industry where disproportionate value will accrue, but you've got to go hunt for it. And what I would say to those people, I think I mentioned earlier on the call, because it's early, because it's young, do your homework, and you can have a bit of an information edge.
And from a market's perspective, over the last 3 or 4 weeks, we've seen this pricing appreciation of the underlying Bitcoin. But you've really seen a bit of divergence, I guess, between Bitcoin miners' share price and the underlying price, which, throughout the thematic of this conversation, is a little bit counterintuitive. Has there been, whether privately or publicly, have there been Bitcoin ETF providers which have invested in Bitcoin miners, and would they potentially have an underlying avenue of exposure to Bitcoin through the ETF, and now they're looking to rebalance their mining portfolio? Is that occurring in the market?
Look, it's a really good question. So I don't really know. I'd need to speak to some of the big block desks who are doing some of the big block trades to understand that. I think it's fair to say, though, that Bitcoin miners have benefited by acting as a proxy trade for those who will not be able to access Bitcoin in the same way that MicroStrategy has. Now, MicroStrategy will argue that it is a leverage play thereof, and it can deliver greater value per share, and I won't repeat Mike Saylor's argument, and there's an argument there. Everyone can have their own view on it. And Bitcoin miners will also often say that too. So I think it's certainly true that I look at my own, I've got a pension in the UK where I worked for 15 years, and that pension frustrates me endlessly. It's there, and I manage it individually, the individual names exposure, and even though I'm an accredited investor, sophisticated depending on which geography you are in, I cannot have any crypto exposure in that. I still can't invest in the Bitcoin ETFs on those platforms, which just makes me want to throw my computer out of the window. So if I want to have exposure to that, there are some of the NASDAQ listed Bitcoin miners I can do, and there are MicroStrategy. All hail MicroStrategy. Thank you very much for my pension for the last year. But so I think they benefited from that, and it's fair. I think it's a reasonable presumption that some of that benefit is stripping away, and I suspect that long term is good for the industry, because what drives performance of executive teams and drives value is conscious allocation by professional investors who do their numbers to the sector, as opposed to just big passive flows. So I suspect that will drive better capital allocation over the long term, and it will probably heighten the cost of capital to some of those miners, which I suspect over longer terms drives better outcome for investors, albeit for me as an operator who's recently raised some capital, that makes my life more challenging. Does that help a bit?
Yeah, it does. I think there's probably two parts to that. One is there's potentially just retailers that have a much easier exposure pathway to the underlying.
Yeah.
And they're simply product switching, and that makes sense naturally. And I do like this thesis of, marginal capital, whether it's lazy capital or intellectual capital. I think that's, I think there's something very true in that. And intellectual capital, when it gets allocated into a segment like Bitcoin mining, then there's probably, once that lazy capital goes, it's actually a really hard thesis to continue to grow. But those strong performers under, similar to Darwinism type concept, they tend to perform really well.
Yeah, I think so. So we'll see how that plays out. And I think we're all, while I personally may have, and I expect you guys have views on this too, about how you want to custody, I think Bitcoin ETFs are a wonderful thing for the sector. And I'm delighted by it. So that, telling my 80-year-old grandmother, here's your ledger, was just never going to cut the mustard. Telling her your platform allows you to direct in this by your self-wealth account, easy conversation. Now my 79-year-old has some Bitcoin exposure. Good. I feel better about that. So whatever gets the outcome, I'm happy.
Absolutely. The ETFs seem to have been a real game changer across, because self-custody is difficult.
Yeah,
absolutely. We have to change tack a little bit, because we've I think you've clearly demonstrated a very deep understanding of Bitcoin mining. But what about yourself personally in the investment space? Are you just in Bitcoin mining, or are you just in Bitcoin, or you have a bit of a play across the whole spectrum?
So I've made some mistakes and lost some money over the last few years. And I guess, like all of us, there's nothing that teaches a lesson better than losing a bit of coin that you've worked really hard to accumulate. And one of those lessons that I've learned, which may not relevant for everybody, is unless you think you know it better than everybody else, or better than vast majority of people, don't touch it. Go passive. So I'm now, my personal approach for whether it's my money or my family's money, is either it's ridiculously passive in equities and fixed income with a certain allocation of my thesis there, which is into ETFs and very, very passively orientated, or it's into things that I think I understand better than most. And for me, that's either Bitcoin itself or Bitcoin mining. And I still have a little bit of Ethereum, and that's more just a pricing dynamic of how I see those two evolving over a little while. And while I have a fascination with other parts of the crypto ecosystem, and I still do, besides my Bitcoin mining work, I still do a little bit of work with two DAOs, help manage their treasury and support them. And that gives me a little bit of exposure to some of this other universe, including meme coins and Web3 gaming. But I probably just don't invest in that sector, because I look at it and think, I just not sure I know more than some or even most. Mm-hmm. And if I don't know more than most, that feels to me as a way I'm just going to lose money again.
Before we started rolling, we're having a bit of a joke about the meme coin. I don't know what you call it, phenomenon maybe. And knowing anything about it may actually be a detriment, because you would never go near a lot of this stuff. But that's not to say you couldn't make some profits speculating wildly on some of these things. As we're here today, I guess the big theme in the meme coin world, it seems to be these political characters. The Dolan Trump. We've got Joe Biden. There's some other ones. In fact, I think pretty sure Donald Trump's son has his own meme coin. We always talk about this because we see these prices go wild. JT, you've got a great story just the hazards maybe of investing in meme coins. But just out of interesting from it, I have to ask, because this phenomenon seems to not be going away. Is it just the case that people are just attracted to just degenerate gambling, or is there anything more to this than just that?
Have you ever been to one of the parts of Asia where you see them put that type of bird inside and everybody gambles on it, and then they put the strap, the sharp device onto their feet? So your question about is human nature interested in degenerate gambling? We know the answer to that, okay, right? And if it's got a sense of community around it, and people love it. What do you reckon, JT?
I think these are the new trading cards.
Like that.
Yeah, but back in the day, everyone would, and I did as a kid, we'd collect upper deck cards, or everyone would have their own poison, and people would spend money, recreationally to sit there and try to, buy things that might have incremental value or other people wanted. That's just moved online now, and it's become much more it's become much faster in the cycle of how you can deploy the modern set of trading cards, I guess, where someone can spin up a new meme coin, create a group around it and a culture around it, and interestingly, that it's very much retail flow. I wrote last week that with Bitcoin and Ethereum and the layer ones and some of the layer twos and the different projects that sit on the new protocols, whether that's AI or gaming or whatever it might be, the smart money comes in and they tend to have an ability to value what the token might be worth in one way or another, whether that's some sort of discounted cash flow model, or that's a projected model, or some sort of token utility model, whatever it might be. Interestingly, for something like a meme coin, there's just no model. There's no model that I'm aware of. So the price appreciation doesn't get capped by an ability for the smart main to sit there and increase supply when it goes above their model price. Naturally, when we think about equities, they could also do the same thing, but the smart money comes in and says, well, you know what, above $3, I'm happy to lose some. And so the supply side builds up. And then the supply and demand equilibrium kicks back in, and you get back to this market price, and we get this organic growth and things continue on. In the meme coin world, it just doesn't exist.
There's no value discovery.
There's no value discovery. So it is purely supply and demand. And when the retailers come in, they can push these things in incredibly far away from any metric that we've known, and at multiples that are significantly larger than tokens which people can get a bit better grasp of as to where their value lies, and they tend to be the bigger market cap tokens. I guess that's the way I sum up meme coins and what they look like, and what's happened more recently over the last week or two in terms of their price appreciation. I think it was Shiba Inu last week. We saw in a 24-hour period that the market cap went from $12.5 billion US to $25 billion US. It's just incredible. And while there are different things that each individual investor are pointing at, I mean, overarchingly, nothing has really changed for it to double in market cap overnight. And this is one of the really interesting things. I think we used to see it in trading cards where there'd be a great Michael Jordan card that came out, and what's it worth? Well, it's worth whatever someone's willing to pay for it. We're seeing that at the moment in meme.
So tell us what we want to know, man. Where do we go next? Come on, where do we put a bit of sprinkle sparkle down?
Oh, well, sorry for taking this digression. I know we're having a serious conversation. We had to go all the way into meme coins, which is a bit of a laugh. But where I wanted to go with this was that you mentioned before, I guess, your mother, she's in her 80s and doing self-custody and navigating the world of buying and selling crypto. I wonder, and I bought more than my fair share of meme coins, but the experience now to go and buy it is becoming really quite, with all this money and attention that's going onto it, it is actually becoming really, really easy to navigate that DeFi world, to flip some Solana onto your wallet and then jump onto a DEX and buy stuff now. It's really intuitive, and I just think, all that money and attention, okay, whether Dolan Trump is worth anything is probably worth zero. But the fact that money flows into this means that the tooling, the experience is being built out, I'm not quite sure what the word is. It's like this kind of gambling happens, but as a result, you end up with this really easy and slick kind of user experience, which eventually will be applied to something more useful than Geo Bowden.
Another great. And the cool thing is that over time, I'm sure this will be rolled out to real world assets. Right, and you have the ability to sit there and on-ramp into layer one token and convert that into a real world asset via DEX. I mean, that would be quite incredible. Being able to buy a specific line or specific CUSIP line in fixed income, in a similar sort of way, and then be able to self-custody that on a software wallet. I mean, that would be quite revolutionary.
Yeah, I mean, it's really quite, I mean, just to use an example, I mean, even just today, for example, I could easily buy some SOL through Independent Reserve, flick it into my, my wallet. It was smooth. It was a few clicks. It was inexpensive. The interface felt like any, something I'd be accustomed to in any sort of TradFi world, but it was seamless. And I've got 100% control of those assets. Well, except for the fact that I then put on a meme coin, but that experience, I mean, surely at some point when that is applied to, anything from buying a car to buying insurance online, there's some...
So for the 70-year-old or the 80-year-old, I love all of that except the part where I've got to go to Independent Reserve. I've then got to send my asset from Independent Reserve to my ledger. I think for the 70-year-old, what they want to do is trust your brand, trust your custody around your brand, think that there's a regulatory landscape that reinforces and justifies that trust, and then they want your wallet to be organic, and that's similar to what sort of Coinbase is experimenting with if it's institutional customers, then to be able to connect with any of those platforms straight into their custody solution you provide. I think when that flow works from a brand they trust, I think that really transforms the sort of the addressable market of people who participate. At the moment, you've got to go into their first KYC with you, then take the asset, buy SOL, send the SOL to the wallet, now participate in the DEX. Life's just getting hard.
The number of steps does kind of make it challenging, but it seems to be it's one of these things that you do it once, it seems overwhelming. So by the second time you do it, it's like, actually, this is child's play. I'm not sure what that means in terms of the future adoption for 70-year-olds doing it, but I think for, definitely for younger people, and I've made this point a few times, is by the time that my son comes through, he's going to be flipping, he's going to expect to be buying anything he likes.
And he'll probably do it inside Fortnite.
Yeah, probably. Or Roblox or Minecraft or somewhere.
Yeah. I agree.
Yeah.
I agree.
Hey, I just had a final question. And this is a little bit more technical question, and we're sort of moving it back from meme coins a little bit. Last cycle, credit was the big problem in the crypto ecosystem. And, there was collateral or uncollateralized lending that was happening in the space. The concept of an ISDA or CSA or one of those things in banking that we know that offer credit protection between two counterparties hadn't yet been formed in cryptocurrency, between cryptocurrency counterparts. Does the space feel like it's gotten better in understanding credit, and does it feel more competent in the credit risk which is being exhibited between counterparties?
Yeah, I think it has. So specifically to Bitcoin mining, I think the machine financing, so lending against a highly correlated asset, always wrong way risk, all the things that you know as well as I do, JT, is highly risky. That's almost completely gone. So now it is any lending that goes out is senior secured, and there may still have some wrong way risk around the exposure, but the quantum of lending has reduced, and the underwriting standards associated with that lending are far more mature. Coinbase has done some recent loans, and the team there, very competent, seasoned TradFi guys, inverted commas, doing it properly, good loan docs around it and the like. I think also what we're seeing in derivatives markets, I know I can speak publicly around it at Quant, we've onboarded with Enhanced Digital Group for our collars. ISDAs, margining, two-way, felt just like what I'm accustomed to. So absolutely welcome all that innovation, and it's got to come, and it's happening. Now, what's interesting is I think the pricing of equity in that sector hasn't yet caught up because the industry is still maturing, but the pricing of credit, both in the context of derivative exposure and outright financing, is definitely improved dramatically.
Where to next then, Glenn? What sort of needs to happen just to take that next level of maturity? Do you think is it more from the industry itself in terms of the crypto industry, learning how TradFi thinks a bit better, or is it TradFi going, you know what, okay, these guys are actually now a lot more investable and a lot more capable than we gave them credit for?
Yeah, it's a good question. So time helps with these things. Cycles, but biggest thing is performance through cycles. If you want to attract investment, which is conviction capital as opposed to sort of hot capital that comes and goes, and no one really wants hot capital on their cap table, that makes for really unpleasant conversations. So if you want conviction capital, then being able to say quarter after quarter, I deliver, take out all of the crypto stuff of this, I deliver statutory profit. Now, that's a word that we don't talk about much in Bitcoin mining. Very few, almost zero, deliver statutory profit after depreciation, after interest, all in, all your exceptionals, deliver a statutory profit. Grow that statutory profit relative to the capital that's employed, which implies margin improvement. Do that as successive quarters. Sustain that when the market falls. When I think most of the people that are professional allocators are informed by analysts, and it would take most analysts, by definition, will sort of follow the herd, and the herd will look for repeatable things that they can drop into their Excel, and it pops out. Mm-hmm. At the moment now, if you're appealing to them, you're either appealing to the hot money, the retail money, or you're appealing to someone who has really, really done their homework and actually believes you are the differentiated proposition. So I think that will happen over time. And the burden is on the participants to say we deserve the capital because we've delivered the results. That's not the capital's problem. That's our problem. That is the issue is.
Absolutely. Very good. Before we let you go, Glyn, we can't go before we get a bit of a prediction from you. I keep asking JT, he doesn't give me one. But Glyn, can you, with this cycle, I guess we've got the halving up. Traditionally, Bitcoin makes a bit of a run after the halving. Are we willing to lay some predictions on the table?
So I'm going to do a bit of a cop-out. You know how everybody gets the chart and they go, here's what's happened in the last few cycles. And it's happened, I'll ignore the four. I'll say it's happened 3 times, any reasonable liquidity. It's going to happen again. I just instinctively, all my training doesn't find that compelling. That sort of chartism of it's happened 3 times when this has happened, therefore it's going to happen again. Clearly, I'm invested in the sector. I would like it to go up. And I believe there's the scarcity argument for it to do so and the store of value. So I try not to think about short term. I try and think about 3 to 5 years as my sort of investment horizon. Am I happy holding Bitcoin at this price with a 3 to 5 year? If Bitcoin went to 100,000 tomorrow, would I still be happy holding it with a 3 to 5 year outlook? Yes. If Bitcoin went to 150 tomorrow, would I still be happy holding it for a 3 to a 5 year outlook? Yes. And so I just go back to that. What is gold market cap worth? How much of that market cap is being driven by the precious jewelry sector and industrial applications, which is very, very small? I look at that and think, well, that's the lowest possible hurdle we've got to replace. And that justifies a much bigger number we are today. And we know what's happening with the supply evolving. So I have no idea and I have no view on the next 3-6 months, but my conviction on 3 to 5 years and why I'm comfortable being up to the eyeballs in a mortgage, which I am now, is because I think that's okay. That'll get inflated away and I've got something else that's going to outperform it in 5 years.
Long-term bullish.
Hoorah.
All right. Very good. All right. Well, Glyn, how do people find you if they want to get in touch with the work you're doing at Comment or even with
So you'll find me on LinkedIn. I don't do much on Twitter. I read a lot and a lot of smart people on there and I try and follow them. But you'll find me on LinkedIn and happy to help if I can.
Yeah. Well, Glyn, thank you very much. That was really, really in depth, really insightful. We even thank you for what's the word I'm looking for? Tolerating my indulgence into meme coins and giving us a lot of really, really useful insights into Bitcoin mining.
So I've got 5. I added them up before I came. I've got 5 different accounts with the different businesses I work with in Independent Reserve. So it's a pleasure to put our business with you guys. The service for onboarding has always been fantastic, and you've always been super helpful for us doing that. And I also love coming to the Swans. 2 great reasons why I love Independent Reserve.
Thank you. After a plug like that, we'll have to get you along again.
Hoorah.
All right, that's a wrap.
Thank you, Lee.
Thank you.
Independent Reserve, the trusted cryptocurrency exchange.